The Invisible Engine, the complete guide to data-driven investing. Hook, the invisible engine nobody taught you to drive. They told you the market was chaos, that success was about timing, talent, and a little bit of luck. They told you to trust the experts, the charts, the noise. But what if I told you that the greatest performers on Wall Street didn't guess? They followed a hidden engine, quietly humming behind the madness. This engine doesn't scream for attention. It doesn't chase headlines. It doesn't care about how confident you sound on CNBC. It cares about math. Cold, brutal, beautiful math. And for decades, it's been quietly beating the best brains in finance. Not once, not twice, but consistently. Year after year, decade after decade. And almost no one's paying attention. In fact, the more emotional the market gets, the better this engine performs. Because it's not human. It doesn't feel fear during crashes. It doesn't get greedy in bull runs. It just follows rules. And while others panic, it compounds. While others hype, it holds. While others lose sleep, it prints quiet returns. Now here's the strange part. You don't need to be a genius to access it. You just need to understand how it works. And that's what this story is about. Not financial advice, not hype, but the real playbook behind the strategies that have stood the test of time, from the Great Depression to 2025. And by the end of this guide, you'll be able to see the machine for yourself. But once you do, there's no turning back, because you'll realize just how rigged, emotional, and blind most investing advice really is. So, buckle up, because once we start the engine, the noise disappears. Chapter 1. The Myth of the Genius Stock Picker. They say Warren Buffett is a genius, that Peter Lynch had a golden touch, that some investors are born with it, that magical gut instinct to sniff out winners. But here's what no one tells you. Most fund managers, the so-called professionals, underperform the market. In fact, over the past 20 years, more than 80% of them failed to beat a basic index. 8 out of 10. And yet, every year, new ones rise up like messiahs, promising outperformance, while investors throw their faith and money behind them. Why? Because we're addicted to the myth of the genius picker. We want to believe there's someone out there smarter than the rest of us, someone who sees things we don't. But the numbers tell a different story. At the heart of this myth is a lie we whisper to ourselves. If I just find the right expert, I'll be safe. But investing isn't about charisma, or Ivy League confidence, or fast-talking pitchmen. It's about repeatable systems, and that's where the invisible engine begins. Because behind the scenes, away from the headlines, there are strategies, cold, calculated, and boring, that outperform nearly all the stars. Not in a flash, not in a single year, but relentlessly, over decades. The difference? These strategies don't rely on human judgment. They don't guess. They measure. They apply data across tens of thousands of stocks, filter them based on simple rules, and let probability, not pride, do the heavy lifting. Imagine you had a coin that gave you a 60% chance of winning every time you flipped it. Most people would still try to get lucky on a 10% odds roulette table because it's sexier. But the pros, the real ones, flip that coin again and again. They bet on process, not prediction. The myth of the genius picker sells because it feels good. But the truth? It's not who picks the stock. It's the system behind the pick that wins the race. So next time you hear someone bragging about their hot tip or next big thing, ask yourself, are they driving the engine or just pressing random buttons hoping something lights up? Chapter 2. The Dogs That Bark Back. Picture this. Wall Street laughs as you invest in the worst-looking stocks on the board. The losers, the laggards, the companies no one wants. Why would anyone buy those? They sneer. And yet, year after year, these unloved mutts quietly beat the pedigree names. Welcome to the strange power of the dogs of the market. Stocks with terrible headlines, low price to earnings, collapsing sentiment, and massive long-term upside. These dogs don't bark in excitement. They growl in warning. I've been thrown out, but I'm not done yet. And if you've got the stomach to hold them, they bite back, hard. It's counterintuitive, isn't it? Buy what no one wants. Hold what makes people nervous. Bet on the ugly, not the beautiful. But history shows us something profound. When stocks fall out of favor, but their fundamentals remain intact, they often rebound with a vengeance. Not because of momentum or magic, but because of reversion to the mean. Imagine a stretched rubber band. The further it's pulled, the harder it snaps back. That's what happens when you buy undervalued stocks. Not always immediately, not every time. But across thousands of data points, the pattern is shockingly consistent. Take the classic 10-stock value portfolio studied over decades. Every year, it selected companies with the worst price-to-sales ratios, the dogs of the market. On paper, they look like garbage. But over time, they crush the broader indexes. No storytelling, no CNBC praise, just numbers. Because deep value works. It works because people overreact to fear, oversell in panic, and abandon perfectly decent businesses at fire sale prices. And here's the kicker. The strategy was simple, transparent, publicly available. Anyone could have copied it, but almost no one did. Why? Because holding a portfolio that looks like a joke takes guts. It means watching everyone else chase shiny tech names while you hold the financial equivalent of rusted-out junkers. But if you can silence the noise, if you can stay rational when others are emotional, the rewards compound. So, the next time a company looks too beaten down to touch, ask yourself, is this a dog with fleas or a dog about to bark back? Chapter 3. The Seductive Siren of Short-Term Thinking. It starts with a whisper. This time, it's different. You hear it during bubbles and Reddit threads across the dinner table. You've got to get in now, they say. Look at this chart. It's going vertical. We've all heard it. Maybe we've even said it. Because short-term thinking is seductive. It flatters our instincts, fuels our FOMO, and wraps irrationality in the costume of logic. But underneath, it's a siren song. And it's sunk more investors than any bear market ever could. Let's rewind to 1999. The world was drunk on .com euphoria. Pets.com, e-toys, webvan, companies with no profits, no paths to profitability, but skyrocketing stock prices. College kids became day traders. News anchors hyped IPOs like lottery tickets. Everyone wanted in, and if you warned of a bubble, you were dismissed as too old to get it. But then, crash. $5 trillion in wealth vanished, and those same voices said, no one could have seen it coming, except the engine did. The invisible engine we talked about, it had already started to pull back. Its models were flashing red. Not based on opinion, but fundamentals. Sky-high valuations, collapsing earnings, irrational expectations. The engine didn't panic. It simply stopped buying the hype. And when the fire came, it didn't burn. It rebalanced, it waited, and it came out stronger. The same pattern played out in 2008, and again in 2021. Meme stocks, crypto booms, AI bubbles. Every time, the masses forgot history. They chased noise, ignored data, and treated the market like a casino. But casinos are designed to win, for the house. And short-term thinking? That's the slot machine of investing. Addictive, flashy, and rigged to bleed you over time. Here's the truth most people avoid. Markets don't reward urgency. They reward patience, process, and repeatability. Every time you get swept up in the now, you drift further from the machine. You disconnect from the engine's quiet rhythm, the steady hum of logic that beats chaos in the long run. So next time you hear that whisper, this time it's different. Pause. Listen not to the crowd, but to the data. Ask yourself, is this excitement or is this evidence? Because the seduction of short-term thinking is powerful, but once you recognize the voice, you can steer clear of the rocks. Chapter 4. The invisible engine itself. You can't see it, you can't touch it, but it's always there, whirring beneath the chaos, quietly turning noise into direction, randomness into rhythm. The invisible engine isn't a person or a prediction, it's a process, a set of data-driven principles that have outperformed most stock pickers and market timers for the last 100 years. Not because it's flashy or innovative, but because it obeys something far more powerful than human emotion. Mathematical truth. At its core, the engine runs on 4 cylinders: valuation, momentum, size, and quality. Each one captures a different aspect of market behavior. Valuation, buying what's cheap. Momentum, riding what's rising. Size, targeting smaller, underappreciated companies. Quality, filtering for financial strength. Alone, each factor has power, but together, they create something extraordinary. A compounding machine immune to hype, fear, or financial fashions. Here's the paradox. The more data proves the engine works, the fewer people follow it. Why? Because the market rewards discipline. But our brains crave dopamine. The engine is boring. It doesn't chase headlines. It doesn't give you bragging rights at parties. It tells you to stick with a strategy when everything around you screams to run. That's hard, but that's where the alpha lives, in doing what works, not what feels good. Let's get concrete. A simple strategy based on the engine's rules, buying the cheapest 50 stocks based on price to sales, screening out the lowest quality, and rebalancing annually, beat the S&P 500 by a wide margin over multiple decades. Not in backtests, in real life. While mutual funds reshuffled based on narrative, this engine churned forward, compounding steadily. It didn't need to be right every time, just more often than not, across thousands of trades. And here's what's wild. This engine doesn't ask for your intuition. It doesn't need your gut. It needs your trust. It needs you to stop trying to outsmart it and start learning how to ride it. Because when you're in sync with the engine, volatility becomes opportunity. Crashes become rebalancing events, and the future becomes less about luck and more about leverage. The invisible engine is always running. Most people never see it, but those who do, those who plug into its current, often find something extraordinary. Not just better returns, but peace. A calm amid the noise, a compass through the storm. And if you've made it this far, maybe, just maybe, you've begun to hear its hum. Chapter 5. The Curse of Human Judgment. You're smarter than the market, right? You read the news, study the trends, watch every Fed speech. You feel like you just know when a stock is about to take off, or when to pull the plug before it crashes. But let me ask you this. If human judgment is so powerful, why do the data models win? Time and again, studies show that humans, even experts, are terrible at forecasting markets. Not because we're stupid, but because we're biased. We overweight recent events, underreact to real signals, and fall in love with our own narratives. It's not our fault. It's how we're wired. The same instincts that helped us survive as hunters and tribesmen now sabotage our portfolios. Here's the story that proves it. In the mid-1990s, a simple formula, built by James O'Shaughnessy, used data to rank stocks based on valuation and momentum. It had no emotions, no feelings about sectors, no CNBC anchors yelling buy or sell. And yet, this mechanical model outperformed 90% of mutual fund managers. Why? Because it stuck to the rules. It didn't second-guess itself. It didn't get scared by a bad earnings report or seduced by a viral tweet. It just executed. Now, compare that to a fund manager making decisions under pressure, performance deadlines, media scrutiny, gut feelings. Even the best-intentioned investors get pulled off course by their humanity. That's the curse. We crave control, but our instincts are often wrong. We want to feel clever, but it's humility that wins. And it's not just individuals. Massive institutions fall victim too. Look at the 2008 crisis. Entire banks collapsed, not because the math was wrong, but because humans ignored it. They convinced themselves that housing prices couldn't fall. They trusted gut over data and paid the price. So, what does this mean for you? It means if you want to win, you must get out of your own way. Trust in systems over spontaneity. Build rules that remove your worst impulses. And most importantly, stick to them, especially when it feels uncomfortable. Because that's when human judgment is loudest and most dangerous. You don't need to be smarter than everyone. You need to be more disciplined than your emotions. And the sooner you stop trying to outguess the market, the sooner you'll start letting the engine do its work. Chapter 6. The Power of Base Rates That Everyone Ignores. We love a good story. The underdog startup that goes public. The brilliant CEO who turns a dying company around. The breakout stock that made someone a millionaire overnight. These stories stick in our minds. Vivid, emotional, irresistible. But here's the problem. They're exceptions, not rules. And when you bet your money on exceptions, you lose. Every time. Enter base rates, the most ignored, underappreciated, and powerful concept in investing. Base rates are the statistical averages of what typically happens across thousands of cases. They tell you, on average, what works, not what might. And yet most investors never look at them. Why? Because stories are sexy, statistics are silent. Let's say someone shows you a hot new AI stock. It's doubled in 3 months. They've got a visionary founder, massive market potential, and a cult following online. Sounds promising, right? But the base rate, the historical probability, says that companies like this, with no earnings and meteoric price jumps, underperform the market over the next 3 to 5 years. Not always, but most of the time. The invisible engine doesn't care about the narrative. It runs on base rates. This is where power lives, in stacking probabilities in your favor, over and over again. When O'Shaughnessy analyzed 50 years of data, he didn't chase stories. He looked at outcomes. Which metrics correlated with long-term returns? Which combinations worked consistently across time, sectors, and economic cycles? The answers were clear. Buying low price-to-sales stocks outperformed. Small cap value beat large growth. Multi-factor strategies had fewer drawdowns. These weren't opinions. They were facts, buried in the numbers, waiting for someone disciplined enough to notice. But most investors ignore base rates because they feel boring. They don't spike adrenaline. They don't sell headlines. They whisper, "Here's what usually happens," while the crowd screams, "This time it's different." But history teaches us, over and over, that ignoring the base rate is like flying blind into a storm. So, what if you flipped your approach? What if every investment decision you made started not with what's exciting, but with what's likely? What if you trained yourself to think in probabilities instead of predictions? Suddenly, the game changes. You stop chasing noise and start aligning with the engine. You become less reactive, more strategic. And over time, you stop getting surprised by the market because you expected what most forgot to consider. The base rate isn't exciting. It's just effective. And when you learn to trust it, you'll see something extraordinary. Consistency in a world obsessed with chaos. Chapter 7. The Dangerous Charm of Complexity. Imagine a man standing in front of a chalkboard, equations spilling in every direction. Derivatives, regression models, volatility curves, alpha streams. He looks like a genius. He sounds like a genius. He must be a genius. But here's what you don't see. His portfolio just lost 40% because complexity isn't clarity. It's camouflage. And in investing, the more complex the strategy, the easier it is to hide failure, until it's too late. We're wired to believe that the more complicated something is, the more valuable it must be. That's why Wall Street loves jargon. It's why financial firms invent names like quantitative multi-scenario volatility arbitrage, instead of just saying, "We're guessing with a spreadsheet." But the invisible engine doesn't play that game. It wins with simplicity. It strips away ego. It reduces the market to a set of repeatable filters and logical rules, and it lets time do the heavy lifting. O'Shaughnessy proved this over and over. Some of the best performing strategies in his data use just one or two variables: price-to-sales ratio, market capitalization, 12-month momentum. These were basic, blunt tools, yet they outperformed sophisticated models because they avoided overfitting. They didn't try to be perfect. They tried to be directionally right, repeatedly. Think of it like this. A Swiss Army knife looks impressive, but in a real emergency, you want a single sharp blade. Complexity makes people feel smarter, but investing isn't an IQ test. It's an endurance race. The more moving parts you have, the more chances for something to break. And when volatility hits, simple systems bend, complex ones shatter. Consider long-term capital management. A hedge fund run by Nobel laureates, armed with elite models, predicting market behavior down to the decimal. They collapsed in 1998, triggering a global panic. Why? Because the models were too complex, and when the unexpected happened, no one could see where the risk really was. The engine never needed a PhD, just discipline. So here's the uncomfortable truth. If your strategy sounds too smart to explain to a 12-year-old, it's probably too fragile to survive a crisis. But the moment you embrace simplicity, the kind grounded in empirical results, not theories, you shift the odds. You stop chasing complexity to feel smart and start building a portfolio designed to stay alive. Because in the market, survival is underrated, and simplicity, far from being naive, is often the most elegant form of strength. Chapter 8. The Flawed Design of Active Management. There's a stage trick magicians use called the misdirection. They make you look at the wrong hand while the real move happens elsewhere. Wall Street does this too, only their version costs you thousands. It's called active management. You've seen it. High-fee funds run by brilliant managers, trading in and out of positions, claiming they can outwit the market. But behind the curtain, Most of them are just flipping coins in expensive suits. Let's start with the evidence. In a study spanning multiple decades, O'Shaughnessy found that the vast majority of actively managed mutual funds underperformed their benchmarks. Not some years, most years. And over the long term, the odds of consistent outperformance were lower than winning at blackjack. The reason? Cost, inconsistency, and emotion. Active managers chase trends, overtrade, and try to time the market. A strategy proven to erode returns and inflate risk. But here's the real problem. Even when they win, you often lose. Because those wins get swallowed by management fees, hidden expenses, and short-term tax hits. A fund that beats the S&P by 1% but charges 2% is actually behind. And yet millions keep pouring into these funds, seduced by glossy brochures and confident forecasts. It's not just a financial flaw, it's a psychological one. We want to believe someone's in control. We want a hero at the wheel. But investing isn't a movie, it's math. Meanwhile, the invisible engine doesn't boast. It doesn't try to outguess headlines or pivot every quarter. It just applies timeless principles. Buy low, diversify widely, rebalance annually. And here's the kicker. It's available to anyone. No gatekeepers, no $1 million minimums. Just you, your process, and your willingness to stay the course. Even legendary investors have admitted this. Buffett has said that most people, including his heirs, should stick with low-cost index funds. Why? Because the engine beats the ego, every single time. So next time you hear a manager pitch their exclusive insight or proprietary edge, ask one question. Does their track record beat a basic, rules-based system over 20 years? If not, you're paying a premium for performance theater. The invisible engine doesn't wear a suit. It doesn't take commissions. But it does take commitment to data, to patience, to the idea that boring wins. And if you can accept that, you'll stop looking for magicians and start becoming your own. Chapter 9. The Secret Weapon of the S&P 500. You hear it all the time. The S&P 500 isn't enough. You need to do more. Be active. Be agile. But here's the truth that makes active managers squirm. The S&P 500 quietly crushes most of them. Not because it's aggressive or predictive, but because it's boringly brilliant. It doesn't time the market. It doesn't chase fads. It follows one powerful principle. Consistency beats brilliance. Let's decode it. The S&P 500 is just a list. 500 of the largest publicly traded U.S. companies, weighted by size, no secret sauce, no insider strategy. Yet, over the last several decades, it's outperformed more than 80% of mutual funds. Why? Because it doesn't get emotional. It doesn't panic in a crash or get euphoric in a rally. It just tracks the market's natural growth, letting compounding do what compounding does best: multiply quietly. Even more impressive, the S&P doesn't try to pick winners. It lets time do that. Over the years, failing companies fall off the index, and stronger ones take their place. A natural evolution. It's like a garden that weeds itself. You don't have to guess who the next apple will be. The index adjusts for you. O'Shaughnessy's research showed that while some strategies beat the S&P over long periods, very few managers did. And even fewer did so consistently. That's the real weapon here. Not just performance, but reliability. The S&P doesn't try to be flashy. It just works. Now, that doesn't mean it's perfect. There are years it lags. There are crashes. But over time, it recovers because it's diversified, rules-based, and indifferent to emotion. Compare that to a fund manager who panics, shifts sectors, or bets on timing. Every deviation from the system increases risk. The S&P stays still and wins the race. It's like a tortoise in a market full of frantic hares. Everyone's rushing, jumping, pivoting. But the tortoise, slow, steady, unshaken, and in the long run, it ends up ahead. So, if you've ever felt like investing is too complex, like you need to outsmart the world just to keep up, remember this. Sometimes the smartest move is to step out of the chaos and trust the engine that doesn't flinch. Because while others sprint and stumble, the S&P keeps walking. Chapter 10. The Microcap Illusion. There's something intoxicating about a tiny company no one's heard of, a stock trading at pennies, a whisper of a rumor that this could be the next Amazon. For many investors, microcaps feel like buried treasure, volatile, mysterious, and full of untapped potential. And it's true. The numbers suggest microcap stocks have delivered some of the highest returns over multi-decade periods. But here's the catch. Most people never actually capture those returns. Why? Because microcaps are an illusion, statistically real, but practically unreachable. Let's break it down. Microcap stocks, typically companies under $300 million in market cap, do show extraordinary performance on paper. But in the real world, these companies often have razor-thin liquidity. Try buying $10,000 worth, and you move the price. Try selling after a bad earnings report, and suddenly there are no buyers. You're not investing in a stock. You're trapped in a tiny room with a shrinking exit. Worse, these companies operate in risky, unregulated corners of the market. Many are shell companies. Others are one lawsuit away from collapse. Fraud, pump-and-dump schemes, and extreme volatility are par for the course. Sure, a few skyrocket, but most fade into obscurity or bankruptcy. O'Shaughnessy exposed this trap clearly. While microcaps showed the highest raw returns in historical backtests, when you applied real-world filters like liquidity constraints, slippage, and transaction costs, the edge disappeared. It's like seeing gold glinting at the bottom of a swamp. Technically, it's there, but try reaching it and you drown. That's why the invisible engine doesn't chase these illusions. It prefers small caps with enough volume to trade smoothly, companies with track records, audited financials, and room to grow, but without the instability of microcaps. It sacrifices theoretical maximums for real-world reliability. And that's a trade worth making. Because in investing, survivorship matters more than sizzle. You're not here to chase lottery tickets. You're here to compound, slowly, steadily, and sustainably. So, when someone pitches you the next big microcap rocket, take a breath. Ask the hard questions. Can I enter without moving the price? Can I exit during a panic? Can I trust the data? Because real investing isn't about what works in theory. It's about what works in practice. And the sooner you escape the microcap illusion, the sooner you'll stop gambling and start building. Chapter 11. The Small Cap Sweet Spot. If microcaps are a high-risk fantasy, small caps are where dreams become data. This is the sweet spot, the engine's quiet favorite. Not too big to be slow, not too small to be unstable. These are companies flying under the radar, growing fast, and often overlooked by institutional giants who are too large to invest in them without moving the market. And yet, historically, they've outperformed large caps by a wide margin. Why? Because small caps live in the fertile soil of capitalism. They're still fighting to survive, still innovating, still nimble. Unlike mature giants, they haven't saturated their markets or buried themselves in bureaucracy. They're lean, adaptable, and driven by necessity. And necessity, as we know, is the mother of outperformance. O'Shaughnessy's research revealed that over nearly 50 years, small-cap stocks, especially small-value stocks, crushed the returns of their larger peers. But unlike microcaps, these companies were tradable, audited, and real. Investors could actually access their upside without swimming through quicksand. And the reason for their outperformance wasn't magic. It was math. Small caps tend to be underfollowed by analysts. That means less hype, less efficient pricing, and more opportunities for mispricing. Exactly what the invisible engine thrives on. Now, let's make this human. Picture a $400 million regional software company you've never heard of. It's not flashy, but its earnings are growing 20% per year. Its valuation is low. It's expanding into adjacent markets. And it's off the radar of most funds. This is not a lottery ticket. It's a quiet compounding machine, if you know how to find it. This is where discipline matters, because small caps come with volatility. They wobble more than giants. They feel riskier. And during market downturns, they fall harder. But here's the key. They also recover faster. Historically, the rebound from bear markets has been strongest among small caps, especially those with strong fundamentals and attractive valuations. But most investors don't stick around to see the rebound. They panic. They sell low. They flee to the safety of mega caps and lock in underperformance. The invisible engine doesn't panic. It expects the wobble. It prices it in. It balances that risk with reward. And over time, it wins. So, when you're building your portfolio, don't just chase the brands you know. Look beneath the surface. Find the quiet fighters, the scrappy innovators. The small caps with real stories, real numbers, and room to grow. That's the sweet spot. And the engine's been running on it for decades. Chapter 12, the king of value factors. If there were a royal family of investing metrics, most would assume the crown belongs to the price-to-earnings ratio, PE, the darling of textbooks and TV pundits alike. But in the court of real returns, another contender quietly reigns supreme, the price-to-sales ratio. It's not flashy, it doesn't inspire headlines. But over 50 years of data tell one truth over and over. Price-to-sales beats them all. Why? Because sales are hard to fake. Earnings can be manipulated with accounting tricks, tax strategies, and creative definitions of profit. But sales? They show whether money is flowing in or not. It's the raw fuel of business. And when you compare the stock price to that raw revenue, you get a surprisingly powerful predictor of future returns. O'Shaughnessy found that when you sort stocks by price to sales, buying the cheapest 10% and holding them, the results trounce not only the market average, but also strategies based on PE, price to book, or even dividend yield. And here's the best part. This works across sectors, across time periods, and through bull and bear markets alike. It's the closest thing to a cheat code in value investing, and hardly anyone uses it. Why not? Because it doesn't feel intuitive. We're trained to look at earnings. We want companies with big profits and clean income statements. But the invisible engine sees deeper. It knows that sales, especially when combined with other factors like small size or strong momentum, create a powerful foundation. It's like judging a car by how much horsepower it generates before worrying about the paint job. Take, for example, two companies. One earns $1 per share and trades at $15 PE, but its sales are flat. Another earns nothing yet, but brings in massive top-line revenue, growing 30% year over year, and trades at a 0.8 price to sales. Which one is more attractive? In traditional thinking, the first one. But the data says the second, especially when part of a diversified portfolio, is more likely to outperform over time. And here's the twist. The strategy works best when you're uncomfortable. The companies with low price-to-sales ratios often look messy. They're in turnaround mode. They've been abandoned. But remember, that's where value lives. In places most people refuse to look. So next time you're analyzing a stock, don't stop at the earnings line. Go higher. Look at the sales. And if the price is low compared to revenue, you might just have found a crown jewel hiding in plain sight. Because in the kingdom of value, sales wear the crown. Chapter 13, the relative strength reversal. Momentum is intoxicating. When a stock's climbing, it feels like gravity has flipped. You watch the chart rise and think, it can't stop now. And for a while, you're right. Momentum stocks often continue to rise, defying logic and doubters alike. But then, sometimes suddenly, sometimes cruelly, the wind shifts, the rocket stalls, and what felt like certainty becomes a nosedive. This is the paradox of relative strength. It works until it doesn't. O'Shaughnessy's research confirmed what many traders sensed but few understood. Relative strength, or momentum, is one of the most powerful short-term factors in investing. When measured properly, stocks that have outperformed over the last 6 to 12 months often continue outperforming in the near future. Why? Because money follows money. Investors chase winners. Institutions pile into upward trends. It becomes a self-fulfilling cycle, for a while. But momentum has a dark side. It's like surfing a wave that eventually crashes, and if you're not careful, you ride it too long. That's where most people get hurt. They buy too late. They confuse trend with truth. They believe momentum is a law of nature instead of a temporary anomaly. The invisible engine doesn't fall for that. It uses momentum, but with rules. It applies relative strength filters within value frameworks. It buys what's rising, yes, but only when the fundamentals align. And most importantly, it rebalances. It doesn't fall in love. It exits when the data says exit. Take the example of tech stocks in the late 90s. Momentum strategies printed money until they didn't. Many rode the wave up and down. But the engine? It had already started rotating out. Not based on news or instinct, but on metrics. Valuations were stretched. Price-to-sales ratios were absurd. And the models began flashing red. That's the power of disciplined momentum. You ride the wave, but you don't drown in it. What's even more fascinating is that momentum, when used correctly, pairs beautifully with value. That combination, buying cheap stocks that are starting to gain strength, is like catching a rocket just as it lights up. Not when it's already in orbit. The timing is subtle, the math is sharp, but the results, stunning. So, yes, momentum works, but it's not magic. It's a signal, not a story. And if you want to use it wisely, you must resist the temptation to follow it blindly. Use it with a compass. Use it with caution. Use it with the engine. Because momentum makes you rich until it makes you reckless. Chapter 14. The Multi-Factor Matrix. Imagine walking through a dark forest with only a single flashlight beam. You can see a few feet ahead, but not much else. Now imagine lighting up the entire forest with a dozen beams from every angle. That's what multi-factor investing does. It turns a limited single-variable view of the market into a full-spectrum insight machine. And the results? Safer, sharper, and far more consistent. In the world of investing, most strategies rely on just one idea. Value investors hunt for cheap stocks. Momentum traders chase the hottest trends. Quality seekers want strong balance sheets. Each group believes their flashlight is enough. But the truth, every single factor has blind spots. Value often catches falling knives. Momentum can flip overnight. Quality can underperform in growth phases. Alone, they're fragile. But combined, they're anti-fragile. This is where the invisible engine becomes truly powerful. It doesn't just use one factor, it layers them. Price to sales for value, market cap for size, 12-month relative strength for momentum, return on equity for quality. Together, these factors cross-check each other. They filter out noise, they catch false positives, they create portfolios that are stronger than the sum of their parts. O'Shaughnessy's research revealed that when you combine just 3 to 5 of these proven factors, you dramatically improve both return and risk control. The multi-factor model doesn't just look for cheap or fast-growing or low risk. It finds stocks that are cheap and growing and high quality. Like finding a house that's affordable, in a booming neighborhood, and structurally perfect. Rarer, yes, but far more valuable. Let's make it tangible. Suppose you find a small cap stock with a price-to-sales ratio in the lowest 10%, strong momentum over the past year, and a return on assets in the top quartile. That's not a hunch. That's a statistical anomaly, the kind that, over decades, has repeatedly delivered alpha. But without multi-factor analysis, you might have dismissed it as just another obscure name. The beauty of the multi-factor matrix is that it doesn't require genius. It requires structure. You don't need to outthink the market. You need to outdiscipline it. While others flinch at volatility or chase narratives, you ride the engine's logic. But beware, multi-factor investing isn't flashy. It won't impress your neighbor at a barbecue. It won't land you on finance TikTok. What it will do, slowly, quietly, is win. Because when you turn on all the lights in the forest, you stop stumbling, and you start walking with confidence. Chapter 15. The Magic of Market Leaders. Everyone remembers the rockets, the meme stocks, the sudden 300% gainers, the overnight IPO millionaires. But few talk about the quiet titans. The companies that didn't explode, they climbed. They didn't flash, they endured. These are the market leaders, not by hype, but by data. And their magic isn't in surprise, it's in staying power. Market leaders have one simple trait. They win consistently over time. Not always the top performer in a single year, but the compounders, the ones that show up in the top quartile decade after decade. These aren't lottery tickets, they're freight trains. And if you catch one early, or even halfway through its journey, it can transform your portfolio. What makes them tick? According to O'Shaughnessy's research, it's a cocktail of quality, momentum, and undervaluation. Not just growth in a vacuum, but growth that's supported by actual earnings, high returns on capital, and reasonable prices. These are companies with discipline, with leadership, with operational excellence that shows up in every line of their financials. Think of names like Costco, Monster Beverage, or AutoZone. Not glamorous in headlines, but absolute monsters in shareholder returns. Decades of quiet execution, no viral hype needed. The invisible engine loves these kinds of stocks. It doesn't pick them by brand name, but by traits. They might not be recognizable at first, but under the hood, they hum with the same power: durable margins, strong cash flow, and shareholder-friendly strategies. Let's tell a story. In 2004, most investors were obsessed with Google's IPO. But tucked away in the same market, Tractor Supply Company, a rural retailer, began its climb. No one noticed, no media frenzy, but it had all the signals: low price to sales, high ROE, and strong earnings momentum. Over the next 15 years, it outperformed most tech giants. The engine saw it. Most investors didn't. That's the beauty of data over drama. It strips away the emotion. It lets you see what others overlook. And when you focus on repeatable metrics, you stop chasing the latest story and start identifying real leadership. So, the next time you scroll through a top 10 list or hear someone pitching the next 10x unicorn, pause. Ask yourself, does this company have the DNA of a leader, or is it just loud? Because magic in the market doesn't come from prediction. It comes from pattern recognition. And the most powerful patterns are the quiet ones, compounding beneath the noise, climbing without attention, winning without applause. That's the true magic of a market leader. Chapter 16, The Risk That's Worth Taking. We're told to fear risk, to diversify, to hedge, to avoid the unknown like a plague. But what if I told you not all risks are equal? That some risks aren't just worth taking, they're necessary. That avoiding them might be the riskiest move of all? This is the paradox the invisible engine understands, and that most investors miss, because the market doesn't reward those who avoid risk. It rewards those who take the right kind of risk at the right time, with the right structure. That's not gambling, that's strategic exposure. O'Shaughnessy's research uncovered something shocking. The most consistent long-term outperformance came from portfolios with more volatility, more drawdowns, more temporary pain, but greater long-term gain. Why? Because they leaned into areas others avoided: small caps, deep value, and unfashionable sectors. In the short term, these strategies looked messy, but in the long run, they dominated. Think of it like lifting weights. You break down muscle so it can rebuild stronger. Without that short-term damage, you never grow. The market works the same way. Avoiding every fluctuation means avoiding every opportunity for return. The key isn't avoiding risk. It's selecting risk that pays you back over time. And here's the twist. Many of the safest-seeming investments, like bonds or high-dividend megacaps, carry a different kind of risk: the risk of underperformance, the risk of erosion. Inflation eats quietly. Time punishes low returns brutally. A portfolio that feels safe today can leave you stranded in the future. The invisible engine embraces volatility, not recklessly, but intentionally. It knows that short-term discomfort is the price of long-term dominance. It doesn't flinch when markets drop 10%. It rebalances. It buys more of what's cheap. It doesn't chase safety. It builds resilience. And that's what most investors never learn. They confuse comfort with strategy. They confuse stability with success. But the best returns don't come from hiding. They come from participating, intelligently, systematically, and with the stomach to endure the dips. Ask yourself, would you rather sleep well tonight or retire with freedom tomorrow? Because the road to wealth isn't paved with ease. It's paved with informed exposure. And once you realize that, you stop fearing the storm. You start sailing with it. Chapter 17, The Strategy with the Highest Win Rate. If you were told there's a strategy that wins in 86% of all 10-year periods, across wars, recessions, bubbles, crashes, would you believe it? Would you follow it? Or would you still chase the latest trend, hoping this time will be different? This isn't a fairy tale. It's a cold, data-backed reality. According to O'Shaughnessy's extensive research, one strategy outperformed all others in both return and consistency: buying a diversified portfolio of low-price-to-sales stocks. That's it. No magic algorithm, no insider information. Just buying the companies that were cheap relative to their revenues and holding them. Why does it work? Because it aligns with how markets recover and grow. Cheap stocks, by definition, have already been punished, often unfairly. They're unpopular, unloved, and overlooked. But when you buy them in bulk, not as single bets, but as a system, something incredible happens. Regression to the mean. The worst often improve. The gap between perception and reality narrows, and with it, so do your gains accelerate. But here's the secret no one wants to admit. Most investors don't use this strategy, not because it doesn't work, but because it's boring. It lacks glamour. You're not buying the next AI unicorn. You're buying the janitorial supply company no one's tweeted about, the legacy software firm quietly turning profitable, the manufacturer trading at half its revenue. And that's why it works, because it lives in the blind spot of the masses. Let's humanize it. Imagine a factory in Indiana. It's been around for 40 years. No fancy CEO, no buzz. But its revenue is solid, its valuation is dirt cheap, its industry is stable. Alone, it's forgettable. But in a portfolio of 50 similar companies, it's fuel. Not every stock soars. Some go nowhere. But enough recover, sometimes spectacularly, that the system wins. And here's the kicker. It doesn't just win more often, it loses less. During downturns, these cheap stocks don't have far to fall. They've already been punished. They're closer to the floor. So when the market crashes, they wobble, but they don't shatter. And when the rebound comes, they rise fast. This strategy is the engine at its most efficient. Simple inputs, repeatable rules, long-term compounding, no emotions, no predictions, just execution. So the question becomes, will you follow the strategy that works or the story that sells? Because 86% is more than a stat. It's a challenge, a chance, a choice. And for those who accept it, the odds have never been better. Chapter 18, the buy the story trap. We love a good story. The college dropout who built an empire in his garage. The visionary CEO who disrupted an entire industry. The electric car company that promised to save the world. Stories sell, stories inspire, but in investing, stories lie. This is the buy the story trap, the belief that a compelling narrative equals a compelling investment. It's everywhere, earnings calls packed with visionary language, YouTube gurus spinning fantasies about 100x returns, financial media obsessed with the next big thing. And we fall for it, because our brains are wired for story, but the market is not. O'Shaughnessy's data showed that stocks with the most hype, the richest narratives, the flashiest CEOs, the trendiest business models consistently underperformed over time. Not because the stories weren't exciting, but because the numbers didn't support them. The invisible engine doesn't care about dreams. It cares about fundamentals, valuation, cash flow, momentum. It strips the narrative away and asks, does this company deliver? Here's an example. Back in the early 2000s, a company called Palm spun off from 3Com. The story was irresistible. The maker of the Palm Pilot, a revolutionary handheld computer. Investors rushed in. But the price soared so high, it implied Palm was worth more than 3Com. Even though 3Com still owned most of Palm's shares, the story made no sense. The math didn't add up. But people bought it anyway, until reality hit. The stock collapsed. And it's not just then, it's now. Think of the SPAC boom in 2020, 2021. Dozens of shell companies promised the moon, flying taxis, next-gen batteries, futuristic fintech. Billions poured in. Almost all of them crashed. The narratives were beautiful, but the business models were broken. The engine doesn't get seduced. It doesn't care what the founder wears on stage, or how many views a company's announcement gets. It runs screens. It filters noise. It finds truth in the numbers. It doesn't buy the story. It buys the data. So, how do you avoid the trap? Ask harder questions. When you hear a pitch, skip the adjectives and look at the income statement. What's the price to sales? How's the return on assets? What's the historical volatility? If the numbers contradict the story, walk away, no matter how good it sounds. Because in the market, the best stories rarely come true, but the best numbers usually do. And once you learn to ignore the song, you start to hear the hum of the engine beneath. Chapter 19, the science of prediction. Every investor wants to see the future. We chase charts, trends, news alerts, and economic forecasts, hoping for some edge, some window into tomorrow. But here's the brutal truth. The future doesn't care about your feelings, your Twitter feed, or even your logic. And most prediction models, they're just polished guesses dressed in spreadsheets. So, what do you do in a world where you can't know what comes next? You shift the game. You stop trying to predict events and start identifying patterns. You stop asking what will happen and start asking what tends to happen when this happens. That's not forecasting. That's probabilistic thinking. And that's the core of the invisible engine's power. O'Shaughnessy didn't build strategies based on tomorrow's headlines. He built them from base rates. the statistical truths buried in decades of market behavior. When X factor shows up, say, a stock with low price to sales and high relative strength, what's happened in the past? How often did that combo outperform? What were the drawdowns? How long did the edge last? This turns prediction into probability. It transforms speculation into structure, and it shifts your mindset from reacting to preparing. Let's be clear, you can't know when the next crash will hit, but you can know how different factors behave during recessions. You can't predict the next Amazon, but you can stack your portfolio with traits the early Amazons had. You're not playing crystal ball, you're playing poker, with the deck tilted in your favor. Here's a story. In 2007, before the housing collapse, most analysts were bullish, but the engine, using nothing but math, began rotating out of overpriced financials and into underweighted value sectors. Not because it knew the crash was coming, but because the pattern said it was time to shift. No emotions, just signals. And when the dust settled, the engine's portfolio had weathered the storm far better than most active funds. Again, not because it saw the future, but because it trusted the past. That's the science of prediction done right, using large, consistent, emotionless data sets to guide decisions, not dictate them. It's humble, it's quiet, but it's powerful. So, the next time someone offers you a bold market call, AI is the next gold rush, or tech is over, ask yourself, is this a narrative or a probability? Because in the long game, the engine doesn't need to be right every time. It just needs to be right often enough, and disciplined always. And that's how you stop guessing and start compounding. Chapter 20, The Emotion Proof. Portfolio. The market rises and you feel brilliant. It falls and you feel betrayed. News breaks and your gut twists. A viral tweet, a sudden crash, a hype cycle, and your once solid strategy starts to wobble. This is the investor's inner war, logic versus emotion. And more often than not, emotion wins. That's why you need more than a good portfolio. You need an emotion-proof one. What does that mean? A portfolio designed not just for performance, but for psychological survival. One that doesn't rely on your discipline, but builds it in. A structure so strong it protects you not just from market volatility, but from yourself. O'Shaughnessy understood this better than anyone. His research didn't just look for returns, it looked for durability. What strategies not only outperformed, but kept investors in their seats through fear, greed, and chaos? The answer was clear. Rules-based, factor-driven systems that removed the need for constant decisions. No reacting, no panicking, just executing. Here's why it matters. During the 2008 crisis, many portfolios dropped 40% or more. Investors bailed. They locked in losses. But those with emotion-proof systems, they rebalanced. They bought more of what was cheap, and when the market rebounded, they came back stronger. The engine never flinched, and neither did those who trusted it. An emotion-proof portfolio is built on a few key principles: diversification across factors, not just stocks, but styles, value, momentum, quality, size. Preset rules for buying, selling, and rebalancing, so you never have to decide in the heat of the moment. Automation, wherever possible, using tools and systems to execute without hesitation. Historical perspective. Knowing how your strategy performed in past crises builds confidence to hold during the next. And most importantly, it's built on self-awareness, knowing that you will feel fear. You will be tempted, but the portfolio won't. It will hold the line for you, if you let it. This is what separates temporary gains from lasting wealth. Not intelligence, not timing, but the ability to stay invested, stay rational, and stay out of your own way. Because when you build a portfolio that protects you from yourself, you've already won the game most people never finish. And in a world that screams at you to react, the quiet hum of the engine, calm, steady, relentless, becomes your greatest advantage. Chapter 21, The Future Backtest. Most investors look at the past to justify the present. This worked in the 1980s. Here's how value performed after the dot-com crash. But what if we flipped the lens? What if we built portfolios not just backward-looking, but future-back, using history not to worship the past, but to prepare for what's coming? That's the engine's final revelation. It doesn't just ask what worked. It asks, what still works when the world changes? Because the future isn't a carbon copy of the past. Markets evolve. Technology reshapes industries. AI is changing decision-making. Climate is altering resource allocation. Demographics are shifting economies. So, the question is no longer, what was the best strategy? It's, which strategies have enduring DNA? O'Shaughnessy's genius wasn't that he found what worked once. It's that he found what worked over and over, across regimes, countries, decades, and disasters. Value, momentum, size, quality. These weren't fads. They were forces, rooted in human behavior, market structure, and timeless math. And now, we stand at the edge of a new era. Robo-advisors, tokenized assets, quantum computing, meme culture meets macroeconomics. It's easy to feel overwhelmed, but the invisible engine doesn't flinch. It asks, which signals still matter, regardless of the noise? For example, AI-driven ETFs are hot, but underneath, what filters do they use? Price to sales, return on capital, momentum screens. The same factors that worked decades ago, now turbocharged with computation. That's the future-back insight. Tech will evolve, but truth remains. You can even apply this to emerging markets, green energy, and disruptive startups. The question isn't whether the theme is exciting, it's whether the fundamentals justify the story. Does it have strong sales? Is it priced attractively? Is it gaining strength relative to peers? That's the engine's checklist, and it still applies in 2025 and beyond. So, how do you future-back test your portfolio? You ask, does this strategy work across time and turbulence? Is it based on behavior, not just backtests? Can I stick with it when the headlines turn against me? If the answer is yes, you're not just investing. You're building resilience into the unknown. Because the future will come, and it won't ask permission. But with the engine as your guide, you won't just survive it. You'll compound through it. And that is the ultimate test. Call to action. Now that you've seen the engine. You've been chasing flashes of brilliance, headlines, hot tips. The latest trend your cousin swore would double. But now you've seen the engine, the quiet, relentless force that's outperformed noise, emotion, and ego for nearly a century. And you can't unsee it. We've uncovered 21 truths, each one cutting deeper into the lies you've been sold, from the myth of the genius stock picker to the trap of beautiful stories. From the seductive buzz of momentum to the cold math of price to sales. You've seen how simplicity outperforms complexity, how discipline crushes intuition, how base rates beat bold predictions, and how a humble set of rules can build empires of wealth, if you stay the course. So what now? You could walk away, numb, overwhelmed, tempted to think on it until the next market panic makes the decision for you. Or you can choose differently. You can choose to act, to unplug from the noise and start aligning with a process that works. Not because it's flashy, but because it's proven. This isn't just about stocks. It's about clarity, peace, power. Imagine checking your portfolio, not with fear, but with confidence. Imagine market crashes as buying opportunities, not breakdowns. Imagine finally understanding the system and using it. And if you've made it this far, let me leave you with this. In a world of chaos, the only true alpha is discipline. Now go. The invisible engine is always running. Most people never see it. But those who do, those who plug into its current, often find something extraordinary. Not just better returns, but peace. A calm amid the noise, a compass through the storm. The engine is always there, quiet, steady, ready to carry you forward. Don't forget the sound of the engine. It's always there, quiet, steady, ready to carry you forward.